and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today. We're continuing during this segment talking about the Federal Reserve and U.S. monetary policy and kind of looking at the effects of that, some of the theory behind it, what has not worked in the past, what we're trying again. So hopefully you're enjoying this. We got a lot of requests after last week's show where we started talking about the Federal Reserve and how it started to continue on with this topic. So if you missed the show last week or you missed the first couple segments this week, head on over to our website, www.dlblain.com, and you'll find archived copies of this show. So we were talking last segment about Keynesian economics and how he never really contemplated this constant budget deficits. His theory was that you had cyclical deficits that were counterbalanced by cyclical budget surpluses, that in good times the government would run a surplus such that in bad times the government could use some of that surplus and possibly go into more debt to counteract the economy, or at a minimum it could be the opposite. They could run a deficit and then a good time use the surplus to pay off the debt. But it was never really contemplated to have a constant state of debt. Milton Friedman, kind of in a similar manner, advocated that we have balanced budgets which were followed or possibly constitutionally required, as he argued, would prevent a buildup of debt. A lot of people said, well, in a recession we want the government to have the ability to go into debt and to pump money into the economy. But what Friedman argued was that some short-term misery was better than the long-term pain and economic jeopardy that we see from long-term debt. We're seeing in Europe right now with some of the countries, and frankly the problem is building in the U.S. And the interesting thing I find about this, I mentioned in the first segment, is I love studying history, financial market history, military history. You can learn a lot by studying. There's a lot of new knowledge that's created every day, especially in the technology arena, and we tend to forget that there were some really smart people that lived a long time ago that had some very wise things to say. And one of them was a man by the name of David Hume, who Adam Smith, if you're not familiar with Adam Smith wrote several great books, and he's the creator of the theory of the invisible hand of the economy. I don't want to get into that, but Adam Smith said that David Hume was one of the greatest minds of all time, and David wrote in 1752 a paper called Of Public Finance. I mean, how many of you even knew that in 1752 anyone was even contemplating public finance or thinking about these issues? Well, they were. And Hume advocated running budget surpluses in good times so that they could be used in time of war or other emergencies. And so, using such a recommendation as that would prevent the scenario that Europe is heading towards today, as well as the U.S. today, that countries would live within their means during prosperous times, and emergency situations would have the resources to respond. And now here's where we sort of veer off into personal finances for a moment. Politicians are against this completely, because it limits their ability to continue their excessive spending and hand out their political favors to everybody. But the reality is this is a basic principle that individuals have to follow in their budget. I mean, why do you think people say that you should save for retirement? When times are good, when you're in your peak earning years and you're healthy and earning, put money away for the future. Put money away for the future. Have an emergency fund so that if you lose your job or you run into a health challenge, you have money available and you don't have to go into a tremendous amount of debt to pull yourself out. We see that bankruptcies for people happen because of medical costs, the loss of job, things like that. And that's why when you're running a, quote, budget surplus, you should save some. Save at least 15% of your income for a rainy day. Well, Mr. Hume back in 1752 was advocating the same thing, and to some extent Keynes was arguing the same thing in his treatise, The General Theory of Employment, Interest, and Money. And of course, we see Milton Friedman arguing for a constitutional balanced budget. I mean, this is just basic, good common sense that we know deep down in our own family budgets that it makes sense. And yet, we continue to allow politicians and the Federal Reserve to go into this deficit spending. I find it interesting that, you know, this past week or so, Bernanke making some more speeches out at Jackson Hole, and in it I thought it would be, you know, listening to some of the things that he say, the past 4 years, it's basically been the same thing. And they continue to try these same policies of deficit spending. He talked about, he said that notably, large-size asset purchases have been associated with significant declines in yields on corporate bonds, which is linked to substantial reductions in mortgage rates, and it appears to have boosted stock prices. This effect is potentially important because stock values affect both consumption and investment decisions. And so basically, Bernanke is out there, you know, the Fed mandate is for employment and inflation, and now he's taking credit for the stock market prices. And I think it's fascinating that when it comes to monetary policy, Keynesians and the policy we're on now, it's sort of this trickle-down economics where if we lower the interest rates and pump liquidity into the market, which, let's face it, benefits people that own stocks, you know, that own financial instruments, and that somehow this will trickle down into employment and to the little guy. But the same people, if you advocate for a tax cut or preserving the current tax rates that are today, you know, they decry supply-side economics and that it's only a tax break, you know, for the rich and the wealthy. But at the same time, they're all for more stimulus spending from the federal government and more action by the Federal Reserve that will somehow trickle down to the average man on the street. And it's just completely diametrical opinions, and it's just kind of fascinating if you listen to this. Okay, well, we're coming up to the end of this show, so just to kind of recap, we talked a little bit about the history of the Federal Reserve, where it came from. We talked about Keynesian economics and how that policy may not be a sound monetary policy. We've seen some devastating effects over the past few years, and we started to talk about the modern era under Bernanke. So hopefully you'll join us next week, and we'll continue talking about this subject. So for All Things Money, I'm your host, David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.